But I'm so glad that you all are here today. And again, my name is Sarah Scruggs. I'm the Community Engagement Specialist at Harvard University Employees Credit Union. HUVCU, or Harvard University Employees Credit Union, is Harvard's not-for-profit financial institution, and we offer products and services that you'd find at any bank, but we offer exclusive products and services to our community here at Harvard. And so it is important to us that we see ourselves as a community resource and do free presentations like this on a regular basis. If you are interested in attending any of our other presentations, you're more than welcome to check out our website, huecu.org, and you can find our other upcoming presentations there. We do have one coming up on October 28th about scams and fraud and protecting yourself and your money from those. So I highly recommend that if you're interested in learning more on that subject. But I'm glad you've joined us today. We're going to go through quite a bit of information today, and this information a lot of times is very general, and I have to be very general. All of our situations are very different from one another. Even if we have the same types of loans, maybe even we graduated in the same year, we're still going to have a different maybe look to our student loans. We may be paying different servicers for our student loans. So everybody's experience is a little different. I have a lot of general great information to go over today, but specific questions and concerns, the number one person to reach out to is going to be your servicer, your student loan servicer, whoever that might be. So we're going to first talk about what types of loans each of us could hold, knowing the repayment options, especially with our federal repayment options, doing research on the federal forgiveness and discharge options, which is going to be imperative happening in the next couple of weeks as we learn more about the federal forgiveness changes, as well as refinancing options. If you do have private loans and that's something that you're interested in, we will speak about that today. So starting with really just understanding what loans we hold and the types of loans that there are out there that you could possibly have. So the first three are really giant buckets. You've got your federal loans, your state loans, and your private loans. You could hold one of these types. You could hold all three of these types. Maybe you aren't the one who's holding these loans, but maybe others in your family are. So for federal, these are going to be your direct subsidized and unsubsidized, Perkins loan, PLUS loan, even parent or graduate. So it depends there. Then with the state, Massachusetts does offer loans. So if you went to college in Massachusetts or grew up in Massachusetts, you could hold a Massachusetts state loan. I come from a state where they didn't have loans to offer students, so those weren't available. So that's why we say it varies by state. And then with private student loans, these could be from credit unions, banks, specifically your university or school, possibly a private company. These are your Sallie Mae's, your Wells Fargo student loans, Discover student loans. So these are not generalized at all. These are all very specific to the certain company that you worked with to receive those loans. If you have federal student loans, any at all, know anybody who has federal student loans and they have questions, studentaid.gov is the best place to go for up-to-date information. Studentaid.gov is broken into many different parts of the website. This is really the home base of all student loans. If you want to find more information on your student loans, things of that nature, this is where you go. But I want to point out this page specifically, the coronavirus page. If you hold federal student loans, you probably know that they have been in forbearance since March of 2020. And so that's been quite some time that folks just haven't been paying on their federal student loans. This is an option that was open to everyone. Some people decided to continue making their payments. Great if you did, you're paying a lot on principal, which would be wonderful. If maybe you didn't and you're not paying on those student loans, it's time to start building those back into your budget, because as someone who keeps up with a lot of the news, I highly, my advice would be to start building it back into your budget, because from what I can see from the news, I don't believe that there's going to be student loan forgiveness in the way that there'll be like canceling of student loans or anything of that nature. I also don't foresee them pushing back the date of when that forbearance will end. Right now, it is slated to end on January 31st, I believe. So you would begin payment February 1st. So I highly recommend beginning to build that back into your budget. But let's say that you've been, saving a lot of money so you can make a great payment on this day. That's wonderful. But it's important to note that you will be picked up to have your payments again. If you have been paying since March of 2020 and you would like those payments back, you can get that money back if you'd like. You just have to request that from the servicer. So a little bit more about subsidized and unsubsidized loans. Let's say that you went to school in the past before, I think this changed about 20 years ago, to be honest with you. They were formerly Stafford loans, but the direct loans is what we call them now. There is no credit check when you receive these loans because they're going directly to the student. So they're tied to the student's social security number and their credit report. And as 17-year-olds, many of us don't have credit reports, so there is no credit check that's required. Subsidized loans are only available to undergraduate students. Let's say that you're thinking about possibly going to graduate school in the future, or maybe a family member is. Subsidized loans would only be available to undergraduate students. Subsidized loans do not accrue interest while a student is in school, and they are only for some undergraduates. You have to qualify through your FAFSA to receive your subsidized loans. You can defer payments on your federal loans while you're enrolled in school at least half time. Like I said, if you are thinking about going back to school soon, you could possibly defer payment on your loans while you're in school at least half time. So this wouldn't be like taking a class or a course at the extension school. That would not qualify you for deferment. You would still be expected to pay. There is a grace period with all federal student loans of 6 months. So your graduation date starts that 6-month clock, and then the federal government hopes you have found a job where you can begin paying for your student loans after 6 months. You can pay for your student loans even before that grace period ends. That's totally fine. They will take their money whenever they can get it, but you do have to start making payments at that 6-month mark. Your rates are based completely on when you borrowed the loan. So rates for student loans right now are pretty low, or they will be if you've borrowed this year. You may have noticed those rates, and those rates are based off of when you borrowed the loan. So let's say that you went to 4-year school. You received a student loan for each year you were in school. Those rates could all be different, and that's most likely they are different. So you are paying 4 different loans once that grace period is over, and you're paying 4 different rates. And that's just because most of the time those interest rates do not stay the same. And so those rates are based off of when you borrowed the loan and not when you're paying it back. Something important to note. There are 2 other kinds of federal loans we'll talk about today, and that's the PLUS and the Graduate PLUS. The Parent PLUS loan, what many of us call it in the financial aid industry, is something that a student would have to apply for. This is our additional funds for students to be able to go to school, but the parent is the holder of these loans. So you may hold some of these loans, even though maybe you didn't go to school, or maybe you are holding these loans now, you're taking out these loans now for your students to go to school. And there is no grace period for these. The expectation is that when you take this loan out, you begin paying on the loan. You can request a deferment, but you have to request it. The federal government is not going to automatically put you in deferment like they would on those direct and subsidized and unsubsidized loans. These are going to be paid off immediately. That is the key there. the parent must complete a credit check for this money to be borrowed. So this is based on the parent's credit score. Interest rate is going to vary. Of course, it depends on when the loan was dispersed. And the disbursement is the year that you borrowed that. So the Department of Education lends these PLUS loans. That's why, of course, it says the federal PLUS loan. These are lent directly from the federal government. And the only difference in between the Parent PLUS loan and the Graduate PLUS is that with the Graduate PLUS, the federal government is now checking the student's credit because hopefully by the time we're in graduate school, we have a little more responsibility and are working a little bit and have some money to pay off those loans. There is a grace period with our Graduate PLUS loan because they expect the student to be in school at least half time. So maybe they aren't making a complete full salary to be able to pay on these loans right now. So there is a grace period of 6 months once the student graduates from school. They can be in deferment while they're in school, right? So with the Graduate PLUS loan, you do not have to begin making payments until 6 months after school. Some information about private student loans. Private student loans can be borrowed through a number of different places, including the credit union. The credit union does have private student loans, and the terms are varied based on lender. That's one of the reasons we recommend people shop around for these rates, because you can find a wide variety of rates. A lot of times these are based on your credit score. More than likely, a student who is taking out a loan from a private lender, especially for undergraduate, they will need a co-signer on that loan, which means that they will need somebody who has additional credit experience to co-sign on that loan with them, and they will both take responsibility for that loan. Shopping around for interest rates should take place within about a two-week period, because then it will only hit your credit score one time. If you're shopping around for one product within 2 weeks, so you're looking at different interest rates, you're trying to determine which is best for you, take 2-week period and make sure to apply for those loans then to be able to see what that credit check is, okay? The grace periods differ from lender to lender. They may not even have a grace period. The expectation may be that you need to repay it now. And repayment terms vary. There are some repayment terms that are 20-year repayment terms. Maybe it's a 10-year, maybe there is an adjustable rate. So it is important that you look into all of those different possibilities when you are thinking about paying back these loans. There could be some potential benefits with a private student loan. You may be asking, why would anybody ever borrow from a private company when there are so many benefits to federal loans? And that is true, but there are some benefits to private student loans as well. Co-signer release options. Once students have made a certain number of qualifying payments on their student loan, a lot of times the co-signer can then be released from liability on that loan, and possibly an interest rate reduction with auto pay. At the credit union, we absolutely offer a reduced interest rate with automatic payments, because this means, number one, we know we will always be getting our payment on time. And number two, this helps us to know when that payment will come in. So when you set up auto pay, we know the date that that money will be coming in and we'll be paying off that student loan. So we'll offer you an interest rate reduction for doing so. So that could be a little bit of a money saver. If that's not something you already looked into with any of your private student loans, it may be time to ask that question. Is there any possibility of an interest rate reduction with auto pay? To know the details of your federal student loans, I'm going to say this website so many times during this presentation, you're all going to be so tired of it. But studentaid.gov has all the information about your amounts, the rates, and the terms for each of your federal loans. This is only information on federal loans. And it's so important that you are able to log into your account on studentaid.gov and learn more about each of your loans. I highly recommend writing down each of these 3 bullet points for each of your loans: the amount, the rate, and the terms. So this would be, you have $10,000 at a 5% rate for 20 years. Okay, so you would know all of those details about your different student loans. How do we find out details about our private student loans? If we hold any private student loans, we have to go to our credit report. Annualcreditreport.com offers free credit reports once a week until April of 2022. Then they'll go back to what their name tells us and giving one free annual credit report per year. So until April of 2022, they are offering them free for you weekly. So you are more than welcome to go on their website. One thing to note, it is extremely important that you are using secure Wi-Fi. When you go on your credit report, you're going to be putting in information about your social security number, and it is so imperative that you use a secure Wi-Fi system in case there is any way that hackers are trying to get in and get that information. That is one piece of information that having that compromise can mess up a lot of things. So it is extremely important that you use secure Wi-Fi. Your home network should have a password on it. You should be on secure Wi-Fi when you are doing these things. So don't just go to a Starbucks and get your annual credit report on the Starbucks guest Wi-Fi. Use your home network or another network that you know is secure. On your credit report, it will list those 3 things I told you to list out in the previous slide. It will list the amount you have left to pay on your loan, your private student loan, your rate, and your terms. So how long they expect for you to be paying that. So this is where you can really find the information of all of your private student loans. Your federal student loans will also be on your credit report, but there's an easier way to look those up, and that's through studentaid.gov. All right, so now we have made our charts. We've figured out exactly what type of loans we hold, their amounts, their rates, and their terms. Now we need to talk more about repayment options. So now that we know we have these loans, how do we repay those? There are a multitude of federal repayment options. These are just some of the federal repayment options that you see on the screen. I'm not going to go into any of these in detail because I believe this is something that you need to speak with your servicer about to learn more, because I don't know your specific situation, but your servicer can help you with that. I'll talk about the basic repayment plans versus the income-driven plans. For basic repayment plans, these are going to be what is automatically put on your account once you graduate from college and that 6-month grace period is over. Okay, the standard repayment plan is what folks fall into, if that makes sense. So this is a 10-year, you just pay the exact same amount every single month. And this is the one that most people hold at the beginning. Income-driven plans are something that you would have to opt into. And these plans are really sensitive to understanding that hopefully at the beginning of our careers is when we'll be earning the least amount of money that we will earn over our career lifetime. And so those payments will go up as our income goes up. That is the hope, right, of this plan. And the income-driven plan can last anywhere from 20 years to 25 years. You could be paying this off for quite some time, even longer than 25 years. And obviously you can see there are a number of different income-driven plans. And talking with your servicer about which one may be right for you is probably the best thing to do. So if that's some type of thing you need to talk about now, and it's something that you can talk about now while your payments are still in forbearance, you can still talk about this now so that you're able to begin that income-driven plan once the forbearance ends in January. You would just get off on that new foot on this income-driven plan instead of the standard that you may be on now. And so these income-driven plans are really great for a lot of reasons. They're great, number one, because it is more sensitive to your post-grad income. But they're also great because this is the plan that folks need to be on if you are thinking about applying for the public service loan forgiveness. I'm sure you've heard a number of things in the news about public service loan forgiveness in the last 2 weeks. Believe me, it is extremely different and new, and I don't know all of the details of the plan, but I do have some resources to help you. So that is something to think about with income-driven plans as well. You do have to be on an income-driven plan to think about being on public service loan forgiveness. One of the downsides of income-driven plans, these will last for quite some time. You see here 20 to 25 years. That is a long time to be paying student loans. So it's important to note that as well. There are options. Let's say that none of those options will work for you right now. You are just not able, obviously this would be in a time when there is no forbearance because you're not paying student loans right now, but in the future, let's say that you are unable to make any of those income-driven payment plans work, as well as any standard payment plan work. There are two options. There's federal deferment and federal forbearance. First, with deferment, there are some conditions that allow you to defer for one reason or another. The most common reason is going back to school more than half time. That is the most common reason for deferment, but there are a few others, and there are always options to help you when you call your servicer. I cannot stress enough, even if you are unable to make payments, let's just say, you know what, next month I can't make any payment at all. Call your servicer before you do not make payment, because if they have no idea of your situation, they're going to be unable to help you. But if they know your situation, you've tried every avenue, you've tried everything, they will be more understanding with you than if you just never tell them you can't make payment. Forbearance. If you don't qualify for deferment, a lot of times servicers may be able to put you in a very temporary forbearance, which would temporarily postpone repayment. The key word in this sentence is postpone. You will be paying that loan eventually. It doesn't go away. It's not forgiveness. This is forbearance. And the interest will be accruing while you are in forbearance. Right now, in the federal forbearance, we are not accruing interest, which is wonderful. But if you were to go into forbearance for some time or another, you would be accruing interest on those loans. So why do I stress talking to your servicer if you can't make payments? Because the effects of missing payments could be devastating for many reasons. The first being your future borrowing ability. Let's say that I lent you money and you just never paid me back. In the future, would I want to lend you money? No, no, because you didn't pay it back like you said you would. And so this is the exact same thing that lenders see as well. Lenders can see if you've made your payments on time. If you're someone that constantly forgets to pay their bills, constantly forgets to pay back their loans, constantly forgets to pay your credit card, it could affect your future borrowing, including possibly getting a mortgage, owning a home, including possibly renting an apartment. These days, landlords want to see your credit a lot of times, and so it's very important. Also, if you miss payments, it could possibly cut you out of any further federal loans that you may need. So let's say right now you don't have children or students going through school, but maybe in the future you will, and you want to apply for a Parent Plus loan, but you've missed too many payments on your federal loans yourself, it may not be available for your student. Higher bills. Not only do you miss payments and accrue interest while you're missing those payments, you normally accrue fees as well. There are going to be late fees. There just always are. And so you don't want to pay more just because you can't pay right now. Negatively impacting the credit score. I've spoken about this. It is so important to keep in mind that payment history is the largest indicator on your credit score. The largest impact on your credit score is your payment history, no matter if you have a FICO score or a TransUnion score that you're looking at. And then ultimately, if you miss enough payments, there could be government intervention. So government garnishing your wages, your tax refunds, Social Security benefits, and possibly any other income you would be getting from the federal government. So there were some people who did not receive their stimulus checks because the government had to intervene and took those for other payments. So it is important that you keep up with those payments. And if you are going to miss a payment, you reach out to your servicer immediately. So in step 2, we talked a little bit more about those repayment plans. For a private loan, your repayment plan is completely up to you and the person and the company that holds your private student loan. So now we're going to talk a little bit more about federal forgiveness and discharge options. There are quite a few that you see here. Went one too far there. So forgiveness and discharge options that are available, you'll see here many different kinds. One that's most popular on this is probably the teacher loan forgiveness. Many teachers apply for this. If you have a teacher in your life, this could be an opportunity for them to get some loan forgiveness. And then also closed school discharge. There are some schools that close, unfortunately, for whatever reason. And if that is the case, your loan should be automatically discharged. If your school has closed recently and your loans have not been discharged just yet, I would recommend calling and letting them know, my school closed, my loans need to be discharged. If you have questions about any of the other discharge options, you can go to that URL link there. And like I said, this PowerPoint will be made available to you. So you'll have all this information and can go back and look through these. Talking about what so many of us probably have questions about is public service loan forgiveness, or PSLF. I do have information here about what PSLF looked like about 3 weeks ago, and now it looks a little bit different. I'm going to be putting a link in the chat so that all of you can have access to the student aid website that has more information about the PSLF limited waiver. So hopefully for you all, you have this opportunity to look over that. I would be totally fine if during this time you wanted to look at that information and you were like, you know what, I will hear Sarah again some other time, but this information is really good to note. This would forgive a remaining balance on direct loans specifically with the waiver, could possibly be other loans, after you've made 120 qualifying monthly payments. This means you've made 10 years of payments, right? So that is why only income-based repayment plans qualify for this. Because if you just did the standard plan, you will have made all of your payments by the end of 10 years. So you couldn't forgive anything else, right? So during the waiver period, if you are on a different type of repayment plan and you consolidate into an income-based plan before 2022, before October 31st, 2022, you could then be eligible for public service loan forgiveness. Like I said, this is a moving target right now. Public service loan forgiveness is a moving target, but that information on that website is the most up-to-date information straight from the source that we have. And like it says there, forgiveness is only granted under a qualifying repayment plan. This has been pushed to moving to a qualified repayment plan by October 31st of 2022 is your new date. You need to remember, I need to move my payments from maybe a standard or a non-qualifying repayment plan into a qualifying payment plan, income-based, okay? You have to be working full-time, whatever full-time means, for a qualifying employer. qualifying employer is a nonprofit. Public schools, you're going to learn about that, obviously. But a qualifying employer is a 501c3. And Harvard is a qualifying employer. Universities and colleges that are nonprofit or not-for-profit are qualifying under public service loan forgiveness. There is a help tool that has not been updated yet. I'm hoping the update comes in very soon with the new regulations around PSLF, but the help tool can help you to know whether you've worked full-time, whether your employer qualifies for PSLF. So let's say that you started working at Harvard 5 years ago, but the 5 years before that, you also worked somewhere else at a nonprofit, and you want to make sure they both qualify. That would be great, because that's 10 years, 120 months of payments. So let's say that you haven't been paying these past 18 months. The good news there is that while we have been in federal forbearance, those non-payments still count towards your monthly qualifying payments, which is wonderful. That is awesome. And so if you are going for that public service loan forgiveness, it is so important to be in contact with your servicer to know what are the steps you need to complete. There are forms you need to fill out. There are forms that Harvard needs to complete for you. There are forms that past employers would need to complete for you. There is a lot to do with public service loan forgiveness, and it is not an easy process. What they're doing right now is trying to make it an easier process. Will that be the case? I don't know. I don't know for sure if this will make it easier, but I do hope that more people qualify for public service loan forgiveness. This is also a website you can go to. It will have a link directly to the link I put in the chat, but studentaid.gov/PSLF. And this is where you can keep up with who are qualifying employers and that PSLF tool that I spoke about. So now we're going to go into considering refinancing. Something that I want to mention before we kind of dive into the specifics of refinancing. The first being, if you are on federal student loans right now, if you have multiple federal student loans right now, this is probably not the time just yet to start thinking about refinancing outside of the federal government. And the reason for that is just because the benefits of federal loans are oftentimes much greater than any benefit that a private company could offer. That may not always be the case. It may be the case that they get rid of public service loan forgiveness, or maybe they've decided, no, there will never be any type of forgiveness anymore for loans. So then you could lose out on some benefits there and consider refinancing then. But to be honest with you, we don't know what's going to happen in the future with federal student loans. I gave a caveat at the top that said, I don't believe that there will be any large swath of cancellation of loans or anything of that nature, but I don't know. I can't see into the future yet, one day, but not now. And so I really do believe that a lot of the benefits of federal loans do a lot of good for us as loan holders. So when we talk about considering refinancing, this is mainly for those folks who do have those private student loans. What is refinancing? When we think about it, it is a new loan that combines your old loans into one. So more than likely, you maybe took out 3 or 4 different types of private student loans when you were in school, maybe for each year or something of that nature. But let's say that you have begun paying them off, but you found a better rate. Your credit score got higher, you found a better rate. So you want to take your student loans to company B, who has a great rate. Company A what they'll do once you've applied and gotten the loan, Company B will actually pay off Company A for those loans, and then you'll start making payments to Company B. There are some benefits to that. It could lower your monthly payment. A lot of us are looking for that specifically when we think about refinancing, really anything, not just student loans. We are looking to lower our monthly payment. There's always going to be one bill and one interest rate. You're no longer going to be paying the 4 or 5 different interest rates that you may have. You're paying that one interest rate. A lot of times there's no application fee and no prepayment penalties. In Massachusetts, prepayment penalties are illegal. So if a bank says, oh, you can't pay this off, we actually have really good consumer protection. So in Massachusetts, you can say, no, there should be no prepayment penalties. Federal consolidation is different from refinancing. Consolidation is taking your federal loans from like the 4 federal loans that you have and giving them one interest rate, consolidating them into one. Whereas refinancing is totally moving it from one bank to the next. So it's a little bit different. Some things that you should consider before you jump into refinancing. Your interest rate is based off your credit score. Maybe you don't have the best credit score right now and you want to work on getting it higher before you apply for refinancing. Great. That is something to think about. You are going to lose all benefits associated with your first loan. So if your first loan had a great interest rate reduction for automatic payments, you're not automatically going to have that at your next servicer or bank or company. You have to speak with them about any benefits that you may want in this next loan. Your repayment term almost always begins right away. It's really important that you are able to make that first payment right after you've signed those papers. And like I said, some lenders offer that interest rate reduction for automatic loan payments. Maybe your credit score isn't where you want it to be just yet. GreenPath Financial Wellness, a partner of ours, they are a nonprofit. We pay them so that all members of the credit union have access to free one-on-one credit, budget, and COVID-19 counseling, along with federal student loan counseling, very basic federal student loan counseling. And this is free for all of our members. And it is one-on-one phone counseling. So you can schedule a phone appointment for 9 p.m. if that's what works for your schedule. And you can talk with the same person after your first appointment, or you can find someone else to speak with. So this is a really great service, one-on-one. This is the type of people you want to speak with when you have a specific question about your specific instance, because they can find that background for you, right? So GreenPath is a great resource, huecu.org/greenpath. Now talking a little bit about repayment strategy overall. And this could work federal, private, any type of loan, really, okay? In the future, of course. So your current loan, let's say that we have a private current loan of $40,000, our interest rate is 8.5%. Our monthly payment is $552, and our loan term is 8.6 years or 103 months. The amount of interest we'll be paying over that time is $16,314. Well, 8.5% is a pretty high interest rate, especially right now. So let's see if we can get a lower interest rate. So we've got new rates and new terms. Like I said, the terms will be different once you do refinance. So we've refinanced that private loan, still in the same amount. The interest rate is about 3% lower. Our monthly payment is about $120 lower. The loan term is now 10 years, so 120 months. But the interest that we'll be paying over time has gone down about $4,000. So that's great, right? But let's say, you know what? I was actually comfortable paying that monthly payment, that $552. So why don't I continue paying that monthly payment? So you still have that same interest rate from refinancing, but you're able to pay off your loans sooner. So now we're paying off our loan in 89 months or 7.4 years, which lowers the amount of interest we'll pay by about an additional $3,000, which is wonderful. No, I can find so many different things I'd rather do with that money than pay it to the bank for holding onto my loan for me, right? Let's say 552, that's kind of a random number. Why don't I round up to 575, excuse me. So I'm paying $575 on my $40,000 loan at 5.5%. It will only take me 7 years to pay off and 84 months. And I will have saved an additional about $500 from doing that. So you can see how we take these strategies and really think about them. The first move is thinking about refinancing. So if we have a private student loan or maybe a federal student loan when it comes to February, and we're thinking about refinancing, the first thing we need to do is figure out what is going to be that new interest rate and what are those new terms. And you can calculate all of this using the calculators on our website. So it's huecu.org/calculators. I'm going to go ahead and put that in the chat so that hopefully you all can have access to it. But this way, you won't have to go and calculate these on your own. There is some help. We can help you with that. And really just playing around with these numbers. What are you comfortable spending on your loans every month? Try to figure that number out as well. What can you budget for this? We do have a worksheet on our website. I'm going to put the link in the chat as well. I'm not great at typing and speaking, so I will do my best though. But here you can find all of our worksheets. And this is one of them. It is free for you to use. It kind of goes through the steps with you of what I've spoken about today, so that you can kind of get a head start and have a blueprint for that. It would be wonderful if you could fill out a quick survey for me before we end. Of course, I'm going to stick around for questions, but if you could just let me know how this presentation went today, so that way I can continue making these better and continue with offering these to those who are at Harvard. So some of the next steps I want to talk about before we end today or get to questions is the first one. Do your homework. Complete that student loan repayment chart we spoke about with the rates, terms, and amounts. Do that for every student loan you hold. And then research any loan forgiveness options. Maybe previously you didn't qualify for public service loan forgiveness, but maybe now you do. It's on us to figure that out. The federal government's not going to come knocking on our door, unfortunately, to tell us we now qualify. So it is imperative that we do that research as well. And then calculate any savings that you could possibly have with refinancing. Because if, let's say, you took out your loans 10 years ago, and now you're thinking about refinancing, there could be a big difference in the amount that you could pay per month. If you're looking to save on cash flow, that could be an option to you. So start calculating those refinancing savings if those benefits outweigh the costs. And of course, I am not a tax, legal, or investment advisor. Please get all of that advice directly from those who are certified in those things. This is all a general overview to just give you some more information about student loans and student loan repayment.